Hello traders, you are welcome to this video. And in this video we are going to be looking at effective moving average strategies. Okay, so if you are looking to boost your trading game, you have come to the right place. Whether you are just starting out or you are a seasoned trader, mastering moving averages can significantly enhance your trading decisions. So let's jump right in. First off, let's clarify what moving averages are. Okay, it's important to know what we are even dealing with. In simple terms, a moving average smooths out price data by creating a constantly updated average price. That's the reason why it's called a moving average. The average price is constantly updated as more price data is being created. Okay, so as we have more candlesticks being formed, the moving average is calculating the average prices of the assets over a period of time. Okay, that's where this period comes in, right? So if you have a 50 period and you are on the 1 hour time frame, it calculates based on 50 hours, 50 candlesticks, meaning 50 hours. If you're on the daily time frame, it means it's going to calculate based on 50 days, 50 candlesticks on the daily time frame, meaning 50 days. Okay, so that's how the calculation is being done. And as new prices are being formed, the average is being updated. Okay, so that is how it works basically. All right, now there are different types of moving averages, like the simple moving averages and the exponential moving averages. The SMA calculates the average price over a specific number of periods, while the EMA gives more weight to a recent prices, making it more responsive to current market conditions. Okay, now both types are essential for day trading as they help you identify trends and potential reversals more effectively. Now that we've covered the basics, let's talk about how to set up moving averages on your trading platform. Now, most platforms will allow you to customize the time frames for your moving averages, just like how we can see here. This is the MetaTrader 4 platform. You can set the period that you want, select the MA method that you want, whether simple or exponential or any of the other two, and then you can decide if you want your moving average to be displayed on all the time frames or specific time frames. Okay, very easy to set up. Now, after setting up the indicator on your chart, the next thing for us to consider is how to recognize trading opportunities using moving averages. Now, one popular strategy is the moving average crossover. Okay, this occurs when a shorter moving average crosses above a longer moving average. So in this case, let us just use the 9, or instead of using the 9, let us use the 20 and the 50. We've already added the 50 to our chart, so let's just use the 20 moving average and the 50 moving average. Okay, all right. Now the crossover strategy suggests that when the lower period moving average crosses above the higher period moving average, like in the case the 20 EMA crosses above the 50 EMA, we have a bullish signal. Okay, and on the other hand, when the 20 EMA drops below the 50 EMA, we have a bearish signal. Okay, now while moving averages are powerful, they are not foolproof. One common pitfall is relying solely on them without considering market context. For example, during strong news events or high volatility periods, moving averages can lag and give false signals. Okay, always combine moving averages with other indicators and your overall market analysis. For example, we can decide to add on the stochastic oscillator just for additional confirmation. So when we have a bullish signal from the MAs, when we have a bullish crossover, where we can look at the stochastics to know whether the stochastics is also giving us a bullish signal. Okay, so basically what we want to be looking out for is the stochastics pointing upwards, coming from the oversold territory and pointing upwards when we have a bullish crossover. And then for a sell, when we have a bearish crossover from the moving averages, we want to be looking out for the stochastics coming down from the overbought territory and pointing downwards. Okay, that's going to be our sell confirmation. Okay, so basically when we have a sell signal, all we just need to do is ensure that that crossover has been confirmed. Make sure that the the shorter term moving average has crossed below the longer term moving average, and then you make sure that the candlestick has closed below the moving average, and after that you can enter a sell trade, and after that you can set your stop loss just above the swing high. Make sure that the stochastic oscillator or any other momentum indicator you are using for confirmation has come into the overbought and is coming down from the overbought. That will be your confirmation, okay? And then your take profit level can be at the nearest support for a sell, or you can just wait for the bullish signal from the MA. Use that as your exit signal from a sell trade, okay? Now, for a buy, you just have to watch out for a bullish crossover and then ensure that the stochastics is in the oversold territory pointing upwards. Use that for your confirmation. Now, after the candlestick has closed above the moving average and you have the moving averages pointing upwards, after the crossover has happened, you enter your buy and set your stop loss just below the swing low, and then your take profit level can be at the nearest resistance zone, okay? That's one of the ways to exit. Or the other way to exit is to wait for a bearish crossover to happen from the moving averages, and that will be your exit signal for your buy trade. Okay, so basically it's an easy strategy. It's a very easy strategy to use. It's a strategy a lot of traders use. A lot of traders use this strategy, okay? Even though it's effective, it is not foolproof, okay? It does not guarantee profit. So it's important that you always manage your risks properly. Make sure that you always use an amount that you can afford to lose, and make sure that you do not risk more than you can afford to lose, okay? Make sure you employ proper risk management, okay? It's important that you don't trade with a large amount of your capital in one trade. You can be targeting between 1 to 2% of your account just per trade, okay? It's very important, all right? So you don't end up blowing your account in just a few trades, all right? Now, in conclusion, mastering day trading, moving averages strategies can really enhance your trading game. However, remember that practice makes perfect, okay? So take the time to familiarize yourself with how moving averages work in trading, in your trading platform, and experiment with different strategies, okay? Now, as for day trading, because you are targeting just a few trades in a day, so your time frame might range maybe between 30 minutes to 1 hour, since you are just targeting a few trades in a day, okay? So your time frame also matters, okay? The time frame that you are focusing on matters. If you found this video helpful, please give it a thumbs up. Your support means a lot, okay? And don't forget to subscribe to the channel for more trading tips, strategies, and insights that can help you on your trading journey. Thanks for watching and happy trading.